Get smart about money. Why loans aren't free passes, folks. Alright folks, listen up. We need to talk about something serious today. We are talking about loans. Many people think loans are like free money falling from the sky. But let me tell you straight, loans are not your friends. They are serious business, a very serious commitment indeed. Understanding them properly is not just important, it is absolutely crucial for your financial health. If you don't understand loans, you are playing with fire, and you might get burned badly. Now, why is understanding loans so critical, especially in today's world? Everywhere you look, someone is trying to sell you a loan. Buy that fancy new phone on EMI. Get a personal loan for your dream holiday. Upgrade your car with an easy loan. The temptations are endless, aren't they? This easy availability of credit can feel like a blessing, but it can quickly turn into a dangerous trap if you are not careful. Many people fall into this debt trap and spend years, even decades, trying to climb out. Loan Basics 101, what you're really signing up for. So, what exactly is a loan? Let's keep it super simple. A loan is when you borrow money from someone else, usually a bank or a financial institution. This money is given to you with a promise. A very firm promise that you will pay it back. But here's the kicker, folks. You don't just pay back the amount you borrowed. Oh no, that would be too easy, wouldn't it? You also have to pay back an extra amount, which is called interest. This interest is the cost of borrowing that money. So, a loan is essentially rented money and interest is the rent you pay. The person or institution that gives you the money is called the lender. This could be a big national bank, a smaller cooperative bank, or what we call non-banking financial companies, NBFCs, here in India. These lenders are not charities, remember that. They are businesses, and their main business is to make money. The loan lowdown, different debts for different needs, handle with care. Alright, so, you know what a loan is. But did you know there are many different types of loans out there? It's like a buffet, but not all dishes are good for you. Each type of loan is typically designed for a specific purpose. It is very important to understand these different types. You don't want to use a credit card, which often has very high interest, for something that a specific, lower interest loan is meant for. Using the wrong type of loan can cost you a lot more money in the long run. So let's look at some common ones you might encounter in India. First up is the mortgage, or what we commonly call a home loan. This is usually the biggest loan most people will ever take. It's used to buy a house or a flat. Because the amount is large, say several lakhs or even crores of rupees, the repayment period is also very long. It can be 15, 20, or even 30 years. Section 4, the interest trap, how they make money off your money. Now, let's dig a little deeper into this thing called interest. I call it the interest trap because if you're not careful, it can trap you in debt for a very long time. As I said, interest is how banks and lenders make their profit. It's the price you pay for borrowing their money. The amount of interest you pay depends on three main things. The amount you borrow, which is the principal, the interest rate, and the loan tenure or how long you take to repay. Even a small difference in the interest rate can mean paying thousands or even lakhs of extra rupees over the years. So, you must understand this part very, very well. Let's take a simple example. Suppose your friend Raju takes a personal loan of 1 lakh rupees. The bank charges him an interest rate of 12% per annum. This means Raju has to pay 12,000 rupees as interest for 1 year if it were simple interest. However, most loans, especially longer-term ones, use compound interest, where you pay interest on the interest too. Section 5. Your credit score, the golden ticket, or a red flag, to borrowing. Alright, let's talk about something that lenders look at very closely before they even think about giving you a loan. It's called your credit score. Think of your credit score as your financial report card. It's a 3-digit number, usually ranging from 300 to 900, that tells lenders how responsible you are with money and credit. Companies like Sibyl in India calculate this score based on your past borrowing and repayment history. Have you paid your credit card bills on time? Do you have too many existing loans? All this information goes into determining your score. It's like a trust score for money matters. Why is this score so incredibly important? Well folks, your credit score is like a golden ticket if it's good, or a big red flag if it's bad. When you apply for any loan, be it a home loan, car loan, or even a credit card, the lender will first pull up your credit report and check your score. A good credit score, say above 750, significantly increases your chances of getting the loan approved. Not just that, it also helps you get better terms, especially a lower interest rate. Section 6. Kick debt to the curb: winning strategies for loan repayment. Getting a loan might feel like a victory, especially if you needed the money badly. But let me tell you, the easy part is often getting the loan. The real challenge, the true test of your character and discipline, is repaying it responsibly and completely. You need a solid plan, a strategy, to tackle this debt head-on. Don't just make payments when you remember or when you feel like it. You need to be proactive and intentional about becoming debt-free. Drifting along with minimum payments is how people stay in debt for ages, paying huge amounts of interest. The most basic yet most crucial strategy is to make all your payments on time every single month. No excuses. Your EMI due date should be sacred. Missing a payment not only attracts hefty late payment fees and penalty interest from the lender, but it also severely damages your credit score. A lower credit score will make it harder and more expensive to get loans in the future.